This Week in Startups is brought to you by Squarespace. Start building your website today at squarespace.com. Enter offer code TWIST at checkout to get 10% off. And Walker Corporate Law, a boutique law firm specializing in the representation of entrepreneurs. Visit them at walkercorporatelaw.com.
Hey everybody, welcome to a new edition of This Week in Startups, the show where we talk about starting companies, building products that change the world, and there are two things that every startup needs. Now you're probably thinking an idea and a product. Well, if you have a startup, you probably have the idea, and you should have the product already. But after you have your product and you've got your team there, really the two things that startups need are money and growth. And those two things work together. Once you have your product in the market, get a little product market fit, you're going to need some money to grow it. You may need to do marketing, you may need to build the team. And where do you get that money from? You go to investors, and there's many different types of investors in the world. And there's many different ways to fund a startup. Some of the best startups have been funded off of something called sweat equity. That's where the founders themselves have technical know-how, and they don't take anybody's money. They just work on their idea on the weekends while they're working at Google or Facebook, or while they're working as a waiter or bartender, whatever it is. That's sweat equity. Then there's friends and family money. And that's usually a very small amount of money that comes from your friends and family. And when you see a startup that uses sweat equity and their mom and dad, their uncles, and their friends' money, as an angel investor like myself in 150 different startups, you go, oh, wow, that's fantastic. On top of that, you have funding that people who go through the sweat equity and the raising of money from friends and family start to open up to. Once you have that product in market, there are angel investors in the world, like myself. Now, it's very hard to get an angel investor to invest in your company because we're professionals and we see 100 companies in person before we make one bet. We probably read 500 pitches and emails before we meet with 100 people in person. So to get an in-person meeting, you might be 1 out of 10, 1 out of 5, 1 out of 20. And to get invested in again, you might be another 1 out of 10, 1 out of 50, depending on how promiscuous, in fact, the angel investor is. Now, if you are not in Silicon Valley, New York, LA, where there are incredibly specific pockets of angel investors, how do you raise money? And it's been hard. There's too many startups and too many experiments in the world right now. The cost for starting a company has gone down. You used to have to pay to put servers up. You had to buy a $100,000 server, put a T1 in your location and backhaul and all that. This is 15, 20 years ago. It might cost you $2 or $3 million by the time you got your first product out the door. Now it might cost you 10 weeks or 2 weeks to build a product and put it in market. If you're using sweat equity, and hey, maybe you hire a couple of people or a designer with that friends and family money. But things have changed. We're starting to open up the aperture of who can invest in a company. Now, this is going to take a little bit of explaining. If you know this already, it's going to seem very simple. If you've never heard it, there's going to be a lot of terms. But today on the program, we're going to talk about a revolution that's going on called equity crowdfunding. That's the common name for it. You've probably heard of crowdfunding already. Crowdfunding is when you buy a product in advance on Kickstarter or Indiegogo. You take a leap of faith that the Pebble Watch is actually going to arrive, or the Oculus Rift. These were all devices, gadgets that were on Kickstarter or Indiegogo or any of these crowdfunding platforms. In exchange for your money, you got a t-shirt, a high five, or maybe the product. The products typically came a year or two late. They typically were underwhelming, but you were part of something exciting. And if you're an enthusiastic individual who loves the vertical, it was quite nice to see it come to fruition. But you didn't get any equity in the company. And something changed just this past year. In the spring of 2016, the SEC, the Securities and Exchange Commission, acting on something called the Jobs Act, which was done after the Great Recession of 2008 or so. And Obama said, hey, we want to get more people back to work. We want to stimulate the economy. Let's let non-accredited investors invest in crowdfunding campaigns to help more startups emerge, because all the great job creation that's going on starts with a startup company, right? Tesla didn't exist, SpaceX, Google, Facebook. These are all things that didn't exist 20 years ago. They all exist now. and they're all employing tens of thousands of people. It's pretty exciting. So we want to get more startups. They're good for the economy, and we're in a global competitive marketplace. If we don't have great companies taking these new markets, you know who's going to take those new markets? China, India, South America. Probably not Europe. They're so far behind. They're so slow, and they got so much red tape there. They're probably not going to compete. But we have a global competition for ideas going on, and that global competition for ideas requires entrepreneurs. And as I said at the top of the program, those entrepreneurs require capital. They need money to grow their companies. You can only get so far in sweat equity. I've seen companies that have not raised money, like Dine.com, which I was on the board of, actually get to $15, $20 million in revenue without taking any external money. It's pretty exciting. It does happen. It's 1 in a million, or 1 in 100,000 more realistically. So the SEC was finally able to get this information out there to people, and non-accredited investors are going to be able to invest, or actually are able to invest in startup companies. Now, this seems crazy. You should say, well, it's my own money. I should get it to invest it in anything I want. However, here in the United States, the only people who were allowed to invest in high-risk startups were people called accredited investors. And you can look this up on the SEC's website, and my guest who will be on in a minute is going to talk about it in the finer details, because he is truly an expert on it. I am an enthusiast with just enough knowledge to get myself in trouble. But now, accredited versus non-accredited. We're going to get into that. Accredited are rich people who have lots of money in the bank, $1 million, $2 million. Non-accredited is people who don't have $1 million or $2 million in the bank. Those non-accredited people who really should be able to invest in startups are now finally able to. Previously, they were not. And the reason was we were trying to protect those people from scams. We're trying to protect them from investing in, mines in California, or, oil rigs, and, people getting scammed. But now we know that startups are a great wealth creation device. In fact, I would argue that startups, and getting on the cap table of a startup, is perhaps the best great wealth creation technique today in 2017. I can't think of another way to get to enormous wealth better than being an NBA player. And then short of that, I think it's being an investor in startups, an angel investor, early stage investor. In fact, that's why you see Carmelo Anthony, Kevin Durant, and other people in the NBA investing in startups, because they're smart and they know that these are the two best ways to make money in 2017 and looking forward. So today on the program, I have my friend Ryan Feit with me. He is the CEO and co-founder of SeedInvest. Now, you may have heard from my email that we made a big announcement that SeedInvest is going to power crowdfunding, equity crowdfunding, where anybody in the world anybody here in the United States, whether they're home watching the launch festival on remote or at the event live, is going to be able for the first time to invest in the companies live while they're on stage. You might be there. You might not be rich yet. You might say, you know what? I want to put $500 toward this company. Or I believe in this next company. I want to put $500 towards it. It's a startup investment, so it's very risky. But you're an adult with $500. You could spend it in Vegas playing blackjack. You could spend it on poker at your friend's house. You could spend it on beer. You could spend $500 on your data plan in the next 60 days, given how much some of these data plans are costing. It's your money, right? All right, so let me welcome Ryan to the program. Ryan, are you there? Can you hear me?
Yeah, Jason, thanks for having me back. Excited to be here.
Yeah, it's great to have you. And I'm super excited about our partnership. We're going to be doing something very interesting at the Lunch Festival on the 5th, 6th, and 7th in San Francisco here. Did I give a pretty good overview of what is happening in crowdfunding? What did I get right? What did I get wrong?
I have almost nothing left to add. You kind of nailed it. I'll try my best to add a little bit of color. As you mentioned, these laws that we were waiting since 2012 for finally came out in the past year. And because of that, historically, you had 370,000 active angel investors in the US, and the other 98% of us couldn't invest a single dollar into startups. And now, thanks to the recent changes in the past year, we have another couple 100 million people that can actually invest in startups for the first time. So it's really exciting. And to your point, it does effectively enable Kickstarter with equity for the very first time.
So SeedInvest powers this. And everybody knows I've been a big advocate of syndicates. I previously did my syndicate with accredited investors on AngelList. I moved it to a private place called The Syndicate now. And this is for accredited investors. Let's take a moment to just focus on what is the difference between an accredited investor investing and a non-accredited investor. Ryan?
Sure. So an accredited investor, which is around 2% of the country, is someone who makes either $200,000 of annual income or $300,000 of annual income with their spouse, or has $1 million of net worth, excluding their primary residence. So it's a select few people in the country.
And I heard the statistic like 3% or 4% of the country is accredited technically. In other words, making over $200,000 themselves.
Yeah, I've seen anything from 2% to 6%, depending on what you look at. But, the high level numbers are that 370,000 people are actively today investing in startups. So, it's about out of that, let's say it's 2 or 3% of people that are actually accredited in the country. Only 10% or so of those people are even investing in private companies. So it's such a small fraction of the country. And now you're talking about 240 million people in the U.S. that are above the age of 18 that can now actually invest in these startups.
So let's talk a little bit about the non-accredited investors and how they actually participate in this. What is the process for a non-accredited investor for investing in a company that is raising money? How does it work? Where do they go? How do they give you the money? They run a credit card? Take me through the details.
Yeah, so first and foremost, they need to invest into a company that's actually raising capital through a regulated crowdfunding platform or a broker dealer. So SeedInvest is obviously an example of that. On SeedInvest, we'll in February receive over 500 startup applications this month. Historically, we've accepted 1% of those companies. We perform our own independent business and legal due diligence on each of those companies, and then basically open them up for direct investment on our platform. So for the companies that are doing live fundraising at launch in early April, investors will be able to come to SeedInvest.com and look at all of those opportunities, do their own independent due diligence on each of the different opportunities, and invest as little as $500 into the companies. And they'll be able to invest through, typically investors invest through their checking accounts, although you can do wires and potentially you'll be able to use a debit card at that point. But we really have strived to take that offline, painful investing process and make it as simple as buying a share of stock online.
Okay, when we get back from this first break, I want to ask you, what is the process for startups going through this? Which startups should go through this process? And then second, I would like to know if you were advising your mom or your brother or sister who was interested in angel investing, what they should do in year one and year two. In other words, how much money should they put to work and how many companies? What would you actually tell your loved family member to do, Ryan, with their money? With their $5,000 or $10,000 they might want to invest in this category? What percentage of their net worth or retirement would they allocate towards this angel investing category, and why, when we get back on This Week in Startups? Let me take a moment to thank Squarespace for, first of all, making amazing software. I was just working on one of the new projects I'm working on. You may have heard of television show. And we had to make a website. And I just went on to Google Domains, and I was buying a domain over at Google Domains, and boom, you could just, when you're setting up your Gmail, fire up and launch Squarespace. I guess they're partners now. And I was able to fire up a gorgeous website in literally minutes, and it looked like we spent $25,000 making it. It looks professional. It's intuitive and easy to use. No coding is required. And they use state-of-the-art tech. It's super secure. It's super stable, and it's trusted by millions, some of the most respected brands in the world. We, in fact, use it for all of our events and conferences, and you can start your free trial today. No credit card is required. And you'll get a free domain name if you sign up for a year. I'm an idiot. I did it wrong. I signed up at the wrong domain place. I didn't know that I would get a free domain. I got to go back and do that next time. If you decide to sign up for Squarespace, if you do decide that you're going to sign up for Squarespace, which I'm sure you will, just use the promo code TWIST and you'll get 10% off your first purchase. It is an amazing, amazing product. It's super easy to use, and they keep adding features to it, which is one of the great things about the software as a service movement. They keep getting more people loyal to the product. They keep being able to hire more product managers, developers, and researchers to figure out what to make next. And boom, they make amazing product, and they keep the price the same. So things are getting better and better over there at Squarespace. I love the product. Go ahead and follow at Squarespace. Hey, everybody. Welcome back to This Week in Startups. I'm your host, Jason Calacanis. You can follow me on Twitter at Jason. That's Jason on Twitter or Instagram. Yes, I'm showing off that I have Jason on those two platforms. We're here in the middle of a discussion about investing in startups. I know that if I was advising my family or myself 20 years ago, I would say take more risk, invest in more companies, and try to change your lot in life. Because when you're poor or middle class, it's very hard to move up and become rich. It's very hard to go from poor to middle class. It's very hard to go from middle class to rich. It's very hard to go from rich to ultra wealthy. Even in America, which is supposed to be the most just, most mobile society, it's hard. It's hard to do. You're not going to do it in all likelihood by just having a profession, in my experience. And I don't think real estate is going to do it. I think for most of us, the best way is to invest in amazing startups, be diversified, and stick to it. I knew that Microsoft would be huge and Cisco would be huge, and I would have gotten Apple wrong. But I would have made some great bets in the 90s if I had thought about it or had access to these companies. I would have easily put 1 week of my $1,000 a week salary towards a company or two when I was coming up in my 20s, and man, it would have changed my life. But I didn't have a rich dad. No rich dad pulled me aside and said, hey, schmuck, why don't you play some bets? Well, I'm your dad now. I'm telling you, play some goddamn bets. Try to move up and make some big changes in your life by placing bets. That's my belief, but I'm going to ask my guest, Ryan Feit, the CEO and co-founder of SeedInvest, with which we have a partnership, a big partnership at the Launch Festival, and we're going to offer all 120 companies in the Startup Summits to raise money for the first time live on stage. I'm putting a little showmanship into it. And I have made the promise that whichever startups do this, I will put $5,000 into them myself. Pending due diligence. I don't want to invest in anything that's a little shaky on moral grounds or that conflicts directly with one of my core investments, let's say. But I think ultimately none of these will, so I'll be able to put $5,000. You get me as an angel investor if you do it as part of the package. So Ryan, when I left you and when I just brought us back from the break, I was interested in what you would advise a family member. What would you advise your mom or brother to do if they were non-accredited, or you have some non-accredited person in your family? Imagine them for a moment. Somebody in your family is not independently wealthy, Ryan, I take it? Or is everybody just...
Yeah.
Okay.
I have plenty of family members that are not accredited that I can provide some advice to.
Okay, so let's provide that advice. What would you advise them? Let's say the next 5 years they wanted to put a little money to work and maybe change their lot in life. They're 30 years old or they're 50 years old, 30, 40, or 50. What would you advise them? You know, they have a decent job. They're not going to go out of business anytime soon. They've got, 6 months of buffer. They're not going to, go bankrupt. There's no chance of that. And they have some nest egg for retirement going.
Well, I agree with what you said, Jason. I think now that this asset class has been opened up to more people, people should not be just investing in stocks and bonds. They should absolutely be allocating a certain percentage of their overall portfolios into alternative assets. And for the family member who, let's say, is accredited barely and has $1 million that they're going to invest, I would say put 5% of your overall savings into venture capital, into startup investments. So that's $50,000, and I would put it into 25 companies. So just like the stock market, but even more importantly with startups, it's so critical that you diversify not only a small percentage of your overall savings, but take that piece and invest a little bit into different companies, because we all know that any individual startup investment is risky. But if you diversify into a basket of startups, you can really bring down that risk. So I would say $50,000 into startups, put it into 25 startups, so $2,000 per company. The reality is, if you look at venture capital early stage returns over the last 30 years, Cambridge has great data on it. They've returned about 23% per year over the last 30 years, compared to 10% for the S&P 500 and just 5% for bonds. So although the individual startup is definitely riskier, if you do this with your eyes wide open, I think it's a prudent thing for any investor to do.
Now, what if you had somebody who was a little bit younger and they said, listen, I want to go for it. I have $250,000 I got in my inheritance, or I have a $200,000 a year job, and I don't have an extra $20K laying around at the end of the year. I don't want to rent a house in the Hamptons. I want to work in August, and I want to put this $20,000 a year to work for the next 10 years. I want to put $200,000 to work in startups. Would you think that person is crazy, or that they're making a good life choice?
The most important thing from my standpoint is making sure that that person is making an educated decision. It's ultimately their decision. But as long as they understand that they need to take that money and diversify into multiple startups, so do not put all your money in one company, because you're probably going to lose it.
Yeah.
Diversify into multiple startups. Understand that this is not an investment asset class where you can just turn around and sell your stock the next day. You might be on the hold. You might be holding it for 7 to 10 years. So make sure you don't need it in 2 years later. Then then as long as they're educated, I'm fine with it. But diversification is important, and there is less liquidity.
What percentage of startups, in your experience, fail? 70%, 80%, 90%? I mean, you're preaching diversity. Yeah. I'm with you on that. Diversification. What is the percentage that fail?
I think you've got to, based on the data that I've seen, you've got to assume that somewhere between 50 to 80% of companies are going to be zeros. I don't know the exact percentage, but you need to invest in at least 10 companies, and hopefully at least 25, because you don't know, there are so many different risks with early stage startups that you just don't know which ones are going to fail and which ones will carry the entire portfolio. So you've got to spread out your bets.
And what about doubling down on winners? Because right now, do most of the investments that go through SeedInvest and that are doing this have what's called pro rata on them?
Yeah, we do. We typically do have pro rata rights, although it depends on the investment. And it is.
Explain what pro rata is.
Pro rata is basically the ability for an investor to double down, if you said, or invest more money when the company raises a subsequent financing round. So at a basic minimum, you might have the right to invest as much as you need to in order to maintain your ownership percentage when the next round happens. And I think it's smart. I know, Jason, you were one of the first investors in Uber, and we're all not that lucky or that smart, but
lucky for sure.
A little bit of both. But once you have that ownership percentage in a company, the nice thing about spreading out your bets and investing small amounts in lots of companies is that you have information on all of these companies, and you're under the hood, so that for the companies that are taking off, you want to have some additional capital to double down on. And I think it's very important, and I think it's a smart way to go about investing in startups. It's
interesting. I just finished my book on angel investing, which will be out July 18th. I've mentioned it a couple times here. It's going to be called Angel. It's a very we took a lot of time on the name. And Angel is going to come out July 18th, 2017. And in it, my portfolio strategy was maybe invest hold half your money for follow-on investments. I think that pounding the follow-on investments, if you invested in 25 companies, $1,000 each, and there were 5 winners out of that group, let's say 80% die. Those 5 winners putting another $5K in them and quadrupling down or sextupling down, sextupling. How do you say what's that? What is that? Sextuple? I don't know. Somebody tell me what 5 times is. Centupling? Maybe centupling. Anyway, quadruple down to make it easy. Put another 4K in, 5K in. This would be the best model for me is to try and get that follow-on going, because now you're betting in things, like you said, you have information on. Ryan, explain to people what their operational role will be after they invest in a company. Will they be able to show up at the office? Will their name be at the door? Will they be able to sit in on management meetings and board meetings?
Well, the short answer is no, right? For equity crowdfunding and for companies that are raising capital from hundreds of people for the first time, it wouldn't make any. It just wouldn't work if you had hundreds of people showing up at your door
and
being
involved
in every decision.
Yes.
Yeah. So that's just not sustainable. At the end of the day, what you're doing is you're getting a small economic ownership, and hopefully you're going to be able to help the company by being the company's biggest brand ambassador and getting the word out, and helping out the company where you can if they need introduction to certain customers. Now, what we've seen in the past is we do end up having a handful of investors in any given company that have pretty deep domain expertise and can be just as helpful as some of the institutional investors out there. So I would say the vast majority of people that are smaller, new investors are really just going to have an economic ownership and be cheerleaders of the company. But, some people definitely do carry a lot more weight and can be very helpful with these companies.
Yeah, I mean, I think there is a false belief on some part, maybe people in the press, that even an accredited investor in a private company who's putting in $25 or $50 or $100 or $250,000 into a company actually has an operational role at the company, or has complete information on what's going on, or has the ear of the management. In some cases, you don't. You are making a bet in a private company, and it may or may not work out, but you're doing that diversification across it to actually hedge against the fact that, hey, most of them do die. You don't need to have that level of operation. Just like if you buy IBM or Google shares, if you owned 1 million shares of Google right now, it gives you no right to walk in the front door at Google and say, hey, I'm here. Can I speak to Larry?
Yeah, I agree with that. And I was going to say it's somewhere in between a startup where there's a VC that's writing one check and being incredibly in control of the company, and a public company where you have absolutely no involvement whatsoever, and no matter what you do or who you tell about the idea or how many products you buy, you're going to have no impact. This is something in between where you're not going to be involved in all the management decisions, but you actually, collectively, you can make a big impact on these startups that are just starting out. And fundraising is definitely one of the biggest challenges to getting a company off the ground, and so is marketing. So you can help in both those areas.
Okay, when we get back from this final break, we are going to bring in a company that actually did this. They actually did an equity crowdfunding campaign. They used SeedInvest, and the name of the company is Wolf3D. You can see them at wolf3d.io. And when we get back from this break, we're going to talk to the CEO and founder of Wolf3D about having raised $620,000 on SeedInvest. And he's also going to be at the Launch Festival when we get back on This Week in Startups. Let me just take a quick moment to thank Scott Ed Walker and the Walker Corporate Law Group for supporting This Week in Startups. The Walker Corporate Law Group is a boutique law firm specializing in the representation of entrepreneurs and startups, and I've personally known Scott for a long time, and a lot of my angel investments use him as their attorney and speak incredibly highly of him. The Walker Corporate Law Group encourages fixed fees, which they believe really helps startups, and I know it does because you don't get that surprise when you get your bill every month. And they believe, actually, at the Walker Corporate Law Group that billable hours reward inefficiency. They want to get things done, and they want to get it done quickly and efficiently for you. Keep those billable hours actually reasonable so that you can grow your startup and put the capital where it belongs in the product. All of their lawyers have decades of experience. There's no junior associates getting on-the-job training, and they provide tons of services, including M&A, licensing agreements, terms of services, and privacy policies. If you want to talk to the founder himself, Scott Ed Walker, you can call him directly at 415-979-9998. That's 415-979-9998, 979-9998, or you can email him directly, Scott@Walker Corporate Law. Scott@Walker Corporate Law, and you just put in the subject line, Jason sent me. And you can visit walkercorporatelaw.com, and you can follow Scott at Scott Ed Walker on the Twitter. Thanks, Scott, for supporting independent media like This Week in Startups. All right, welcome back to This Week in Startups. My guest, Ryan Feit, is with me. He is the CEO and co-founder of SeedInvest. We're doing a partnership with SeedInvest to allow any company at Launch Festival, the 120 that are presenting in the summit, and a handful of others who will be there, to just launch an equity crowdfunding campaign. Not everybody's going to do it, but I suspect a good number of them will. And any of them that do, I'm going to put on the main stage and put $5,000 in myself to kick things off. Asterisks, pending due diligence. Of course, I want to make sure this company is legit, but all these companies are going to be vetted really, really heavily. My team is picking them. Ryan's team does a due diligence process. And the due diligence processes on these is not perfect. I can tell you I've made many mistakes investing. I have invested in people who have not operated companies intelligently. I haven't had fraud, but I have had incompetence more than once in 150 investments, and I've had people do things I don't agree with. However, given a portfolio, you very quickly learn that you don't need to win every time. You just need to win big once, and it makes up for a lot of errors. And in these early stages, in my experience, 70, 80% die. So 7 or 8 out of 10 bets are going to die. You have to have a psychological fortitude to do angel investing. You need to be willing to get bad beat after bad beat. It would be like if you play poker, sitting down and you get all your money in 10 times, but you only win 3 hands, or you only win 2 hands, or you only win 1. Or you lose none, you do another 10 hands, and maybe you win 1 or 2 then. But if those hands work out to be more than 10x, 20x, all of a sudden you're back in the black, right? And you're not in the red anymore. So it is, I hate to use gambling analogies, but there is risk here, and you have to be intelligent. And there are people who are net positive poker players because they play intelligently, and then there are people who just spew their money and they have no skill at it. Ryan, let's talk about the process for startups. What is the process like for a startup? We have here in the studio one of the companies, Timmu, yes. I got it right, Tõke.
Yeah.
But you're from Estonia?
I'm from Estonia.
Now, Tõke is pronounced slightly different in Estonia.
It is.
It's called
Tõke.
Tõke.
Yes.
Tõke.
Yeah, we have a special letter.
It's like an E on the T.
Kind of, yeah.
Tõke.
Yeah, oh, almost.
Almost. It's very unique. Like, is there any other society that has this?
No. Estonian is the only language. There's 1 million people that speak it.
Say it one more time. Just give me the T sound.
Tõke.
Don't give me the whole name, just the first part.
Is the letter. So there's 1 million people in the world that can say that letter. Yes. Yeah. It feels like, yeah.
Okay.
Tõke. Yes.
Tõke.
You're kidding.
Okay. I'm getting close.
Yeah, you might
I'll keep trying.
Roots.
It's not easy. Okay. So now your company is Wolf3D.
Right.
What does your company do?
So we create realistic avatars of people for VR. We believe that VR and AR are going to be used for communication in the future.
Great.
And in the core of that are avatars.
Great.
So our goal is to give everyone a virtual representation that really looks like you, talks like you, and acts like you in virtual worlds. And
let me play the video, and you keep talking. We'll picture in a picture this.
Awesome. So we started from building hardware-based 3D scanners for creating very good avatars, and now we're actually focused on building a smartphone-based solution instead. And as I said, our goal is to create a virtual representation of everyone in the world for VR and AR communications.
So I'm looking at this right now. I have it here on my screen.
Bringing people into virtual reality. My name is Timmu, and I'm the CEO of Wolf3D. And our mission is to bring humanity into VR. This is a clip from Facebook's developers conference just a few months ago, where the company showed off their new social VR platform. Facebook believes this is the future of social, a world where VR goes beyond individual experiences. As you may have noticed, there's a huge flaw that exists in VR. Your friend is a random, generic avatar, making the experience anything but authentic. Now, the only way to bring your real friend into the virtual world is to 3D scan them. And that's the problem that Wolf3D.
All right, I think we get it. I'll pause this right now.
Yeah.
So basically, you make 3D avatars, you make the technology to do this.
Right.
How does this company intend to make money?
Yeah, so in the first phase, we're actually working with gaming companies. That's our focus. So we license our technology, which is a smartphone scanning app, and we charge the gaming companies per avatar.
Your customers, the gaming company, instead of them having to build their own software,
right,
to put my face on my character in a game.
Exactly.
They just buy it from you.
Exactly. And
you charge them what? $50,000, $100,000?
It depends
$1,000 a month?
It depends on the project and API requests. So
okay, give me a ballpark.
I wouldn't discuss it like publicly, the pricing model, because we're still figuring things out.
Okay, so you haven't actually started charging yet, or are you just starting to?
We're just starting to.
Just starting to.
Yeah.
So this is that early stage of a company.
It is.
That you finish the technology,
Yeah.
and you're starting to have betas, I guess. You're in the beta phase, would you say?
So we actually, as you saw in the video, we had the hardware-based scanner. We're now actually very focused on building the next version of the product, which is based on our database of 10,000 scans, and makes it possible to make the same quality avatars with a smartphone.
Okay,
exactly.
So your pre-product launch.
Yes,
for this
that's right.
version 2. So you had a prototype which was hardware-based.
Yeah.
It was big. It was bulky. You learned some stuff. Now you're going to put it into a 2.0.
Exactly.
So Ryan, this is a company that obviously has a lot of risk, but that is on to something. Tell me about your process for accepting a company like Wolf3D. Why did you accept them to the platform?
Yeah, so Wolf3D, like any company, applied at SeedInvest.com/apply. So same sort of standard application for all companies. The first check is we are looking to fund businesses and not ideas. So it's critical for us that there is an MVP or prototype that is already developed. So Wolf3D's case, they had a prototype that they were using, and I think at the time they'd scanned about 5,000 people. So it sounds like they're 10,000 now. They need to have a full-time team that's in the market, and for us, it's making sure that the company has a level of traction that's is appropriate relative to their valuation. And then the last piece is for us is doing business due diligence, so analyzing sort of their costs and their revenues so far, and also doing legal confirmatory due diligence. We actually caught somebody recently who was a convicted felon who we blocked from the platform, and Timmu, which I probably did not pronounce as well as you did, was not a convicted felon, so that was good.
Congratulations, Timmu. No felonies.
I've done well.
They've all been expunged, huh?
Yeah.
Very good, very good. So there's, you want to make sure there's no fraud going on here, so that's good to get rid of felons. And then you also want to make sure that there's some sort of a real business here. How do you discern that? Take me into your thinking, Ryan, because I have my own thinking about these things, and you got a taste of it there when I was sort of feeling out Timmu. How do you know what's too much diligence and you're not giving people a fair chance to do something creative? Because you could be stifling if you demand, hey, you have to have revenue today. We all knew Google and Twitter and Facebook took a long time before they started hitting revenue. I got to that pretty quickly. Yeah. But how do you know to take a chance on something like Snapchat, which when it launched was very speculative?
Yeah, sure. So with Wolf3D's case, clearly they're not an example of a company that is generating significant revenue. We do have plenty of companies that are in that bucket. This is not a case of that company. It's an early stage company, but we had a lot of data that suggested there was a demand for this. So the fact that they had scanned 5,000 people already, and we saw instances where they've had the scanner in a mall, or it might be at a conference, and there are lines out the door. It shows that people have an interest in this. And from a market perspective, although we all know VR is still very early, Facebook and companies like Facebook are betting really big on VR, and you better believe that Facebook is going to be betting on social VR. Last month, they started to come out with more information on Oculus Rooms, where you can basically interact virtually with your Facebook friends. And from a market perspective, I've got to imagine that everyone's going to want avatars that resemble their friends if Facebook's really going to get into this. So like all startups, definitely a lot of risk. It's early, but there's interesting market potential, and the company, has already taken at least a lot of the prototype risk off the table. Let's
talk about the process. Timmu, what was the process like for you as a founder of doing a crowdfunding campaign like this? The company is based in Estonia or here?
So I spend most of my time here, but the tech team is in Estonia.
Got it. So when you come here to Silicon Valley and you meet with investors, I'm assuming you have investors outside of the SeedInvest round?
Yeah.
What led you to be interested in doing the SeedInvest round? And technically, what did you have to do as the CEO to actually make this successful?
So why we decided to go with crowdfunding was that we're not from here, and we wanted to kind of create a crowd of people that are really interested in our success and can kind of amplify our message. And
so you view the investors as marketers as well,
Yes.
to tell people about what you're doing. They become ambassadors because they're shareholders, but even more than shareholders, they're really stakeholders. They have a stake in your success.
Exactly, that's right. And we chose SeedInvest because in SeedInvest we could actually do a side-by-side race, which meant that we still have accredited investors on board that made bigger bets and can help us along the way. And we also have around 200 small investors that exactly amplify our message. And that's how we saw, that's the benefit of kind of equity crowdfunding. The process was quite straightforward. I mean, we applied, we chose SeedInvest because we thought they're the best platform. So we applied, and we had the first a few days, just a quick first due diligence where SeedInvest discussed if our, basically the business due diligence. And when they were, when they agreed to go forward, then we had, there was a long process of legal and business and market and whatever due diligence, which took like 1.5 months or so. So that was very, very detailed and went very, very deep from their side. And when that was done, then we could launch. Obviously, there's many restrictions on how you can market your deal and so forth. But overall, it was a 1.5 month process to launch a deal, and it was quite straightforward. And SeedInvest has been and was very, very helpful.
How did it break down, just ballpark, in terms of accredited investors versus non-accredited for you?
So actually, most of the investments came from accredited investors, so around 70%, I believe.
Okay, but still 30% is very significant.
Exactly.
It's going to be $200,000 or a third of it or so is going to come from non-accredited investors.
Yeah.
And what is the average size investment? The minimum was $500, $250? What was the minimum?
Yeah, the minimum was $500 for our deal, and I guess the average was around $1,000, but a little bit more maybe.
For you, how do you keep those $500 people involved versus somebody who put in $50,000? I'm sure you have a $50,000 investor in there. How do you treat those two differently? How do you prioritize if one put in, literally 100 times more than the other person?
Yeah.
Obviously, they're more important, they have more at stake. But have you seen that the people who put $500 provide more value than the $25,000 or $50,000? Is the effort that the investor puts in correlated to the dollar amount?
I guess it's a little bit too soon to say still because we closed 2 months ago.
Okay.
But we do give more updates, and we keep closer contact with the bigger investors.
Sure.
But for the crowd, for example, we just started a weekly vlog. So we're just showing what we do, speaking about our stuff, gaming.
A weekly update.
Yeah, a weekly update. This is not specifically for investors. It's just a kind of a vlog, a piece of content that we want to bring a community around.
Got it.
But it's also for the investors. So they
So they can get an email and they can sign up for it and get...
They see YouTube videos of us doing stuff and see our development, which is, I think, is good.
Ryan, this is a best practice, keeping your investors up to date, you would say?
Yeah, it's critical.
Why?
Well, first of all, the companies that are utilizing equity crowdfunding, if they shouldn't just be doing it to raise the capital. So just like Wolf3D, there's a lot of value you can get out of the investors as well. Virtuix, which we've talked about before, raised capital recently on our platform from about 1,500 people. And they send out a monthly update where they provide an update on what's going on with the company, but they also ask and they tell investors, this is how you can help me. Can you help me? Can you help connect me with a distributor? Can you help connect me with this type of a business? So it's all about the entrepreneur doing a good job of not just providing feedback, but asking for help. And why is it important that you keep your investors in the loop? Like, I know you've said this before, Jason, every company needs more money at some point. And the worst thing you can do is to keep your investors in the dark and then shoot them an email a couple weeks or a month before you need more money and ask for more money after you left them in the dark. So, I mean, it is startup 101.
Yeah, if you keep them informed and they put in 500, as we discussed earlier, they might want to quadruple down and put in another 2,000. And if it's a $50,000 investor, they might want to quadruple down and put 200,000 in if they see demonstrative progress rather. What does it cost, Ryan? So what did Timmu, aside from his time, have to spend doing this? Because I know that when you do an accredited investment, there's about $8,000 in legal fees to set up the LLC for all those investors. And all of the different platforms have to pay that. I pay that when I do one. That typically comes out of the investor side. So the investors put in $208,000, $8,000 goes to pay for the legal fees, 4% or so. But it's capped at 8%, and that goes across and the founder essentially gets $200. But for non-accredited, you don't have carry. You don't have a syndicate lead. How does that work? What does it cost? What are the costs?
Yeah. So first and foremost, for the companies, we are totally success-based. So there are no upfront costs to the companies. If a company gets through our investment committee, SeedInvest will handle all the costs upfront in terms of setting up escrow agreements, LLCs, things such as the legal confirmatory due diligence. We'll eat all of those costs. And then, basically we get paid a success-based fee if the company does well and raises capital. So we get paid 7.5% of whatever is successfully raised in cash. And then we take a small piece of equity in the company as well, which is where we hopefully will see the most value in these companies. We're ultimately trying to build a portfolio over time. On the investor side, we are pretty unique. We actually don't charge anything to investors today. So no carried interest. We don't take any piece of the upside, and we don't charge any fees. So it's completely free for investors to sign up and invest.
Now, what are the costs, though, to run one of the equity crowdfunding? There's some fee, right? Some fee that startups pay?
Yeah, it's all success based. So it's the 7.5% in cash of whatever successfully raised, and then it's basically 5% of whatever is raised in equity. So if you raise $1 million, $50,000 in equity at the same price as the current round.
Got it. So for you, Timmu, that seemed reasonable.
Yeah, it did.
You're paying, if you raise 200, you pay 15,000.
Yep.
That, I guess, you're not making a profit from that, I'm guessing, Ryan. That kind of keeps that nice glass office behind you and pays that expensive rent in Manhattan, I take it.
Mm-hmm.
Yeah, we're trying to cover our costs to the extent possible on the cash side of things. Mm-hmm. Obviously, if a deal is not successful, we lose money on that. So, we need the companies that are successful to also cover the other ones. We're looking to break even and eventually continue to build a portfolio of equity positions. We have equity in about 50 companies right now, and we're hoping to fund 100 companies this year. So at the end of the day, the value for us is going to be continuing to help our portfolio companies and hopefully have some good exits out of this down the line.
Awesome. All right. Well, this has been, I think, a pretty good overview. What is your next step as we wrap up here, Timmu? What is your next step as a company? Mm-hmm. When you raise this money, does it give you 6 months, 12 months, or 18 months of runway? And then what do you do now? What are your next milestones?
Yeah, it gives us about 14, 15 months of runaway.
14 or 15?
18 if we really want to.
Okay, so you can sleep at night. That's why you look so fresh.
Yeah, exactly. I'm pretty jet lagged, actually.
Okay.
So the next step for us is to launch the new product and to sign up first big customers to really take it to the market.
And if you're spending like $30,000 to $50,000 a month as a startup, what's your burn?
Yeah, it's about 30 at the moment.
30 at the moment. So you're pretty cash efficient.
Yes.
Is your next goal, so your next goals are get the product to market. Mm-hmm. What is that going to take you, 6 months?
It's going to take 3 months.
3 months?
Yeah.
Then you got to test it a little bit for a couple of months.
Yeah.
Probably tweak it.
Yes.
And you've got to start a sales process with these game companies. Maybe you've started that already.
We have, yes.
And you got to close some of those deals. Mm-hmm. I'm going to guess it takes 6 months to close a deal, maybe more. So probably a long sales cycle.
Yeah, we're in discussions with many of the biggest gaming companies and publishers.
Okay.
And it's
how's it looking?
It's looking very positive.
Okay.
Yes, but there's buts always, but it's going well. And
so you're getting meetings.
Yes,
you're getting second and third meetings.
Yes.
Have you gotten any to the contract stage yet?
No.
Not contract. Okay, so just so people know, when you hear me asking questions like this is the dialogue that an investor has with a founder,
course.
which is, I'm trying to suss out where exactly you are. Okay,
Right.
so the product, you've had multiple conversations with some customers, but you haven't gotten to a proposal stage yet.
Yep.
So you got to get some of those proposals out. That's going to happen by the summer, you think?
Yes, I think by the summer is a good timeline. But we were focused on the product, the previous product, and getting scans in very much before the raise. So after the raise or during, we really started going out to gaming companies and speaking with them. So
Do you think you can close one by the fourth quarter?
yes,
You do. You're confident. Highly
Yes.
confident? What percentage chance do you give yourself of closing
85.
85% by the
Yeah.
end of the year? If you can't close a deal by the end of the year, what does that tell you about your product?
Well, I guess we won't go that far. Like we probably get a good idea of the market before the end of the year.
Hopefully, yes.
Yes, and
So if you start getting to that point where you can't close a deal, what do you do? Do you
We
have to pivot a bit?
Yes, we pivot into another market.
Yeah.
So there's many places you can use your avatar at, like fashion, like online retailers, and all kinds of things you can do with it. Gaming seems to be the logical step for us to get to VR eventually. So that's why we're very focused on that, and we really want to do that. But I think in the next 3, 4, 5 months, we will definitely learn and find out if that's realistic or not.
Yeah, you can't sell this product directly to customers.
No.
There's not a market for that. You don't think?
We could create a consumer app, create GIFs and like things like that. So that's also
Maybe.
that's also an opportunity.
But consumers wouldn't pay for that, maybe.
No,
Maybe
no.
they pay $1.99 for an app or something. It'd be very hard to get to 15,000 people a month with a subscription. Or
Yeah, but you can do ads. You can turn people into avatars and have them wearing like a Nike shirt or something like that.
So that could work for a social network or
Yeah,
something like that. But it puts
exactly.
you kind of head to head with a Snapchat or somebody who uses filters.
Yeah, a little bit. But it's a next level from there.
And Ryan, when a company doesn't have all of the answers like this, that's not a signal of weakness. It's a signal that it's an emerging market, correct, in your mind?
Yeah, it's again, with an early stage company, especially one that is pre-revenue, you just have to price it appropriately. And that's part of the process. That's why you invest in multiple companies. And we think that there is an ability down the line, if it's not on the gaming side, to have VR scanners in airports and malls and theaters and retail stores. We see real potential for that. And the nice thing about this model is that I agree with you. It's going to be about scaling through some of these big partnerships. And just landing 1 or 2 of them in the next 9 months.
So when you raised $900,000 in total, $620,000 of which came from SeedInvest, was this at a $10 million valuation? What was the range of the valuation?
Our SeedInvest pre-money valuation was 4.5.
4.5.
Yeah.
So the $600,000 post money. So if it was 4.5, you had 900. That's 5.4 million post money.
So the first round was before SeedInvest.
Yes.
And now the post is like 5.1.
5.1.
Yeah.
So you had a 5.1 post.
Yeah.
Which means if you put in $510,000, you had 10% approximately. If you put $500,000 in, if you put in 50,000, you'd have 1% of the company. If you put in 5,000, you'd have 0.1. 10 basis points. And if you put in $500, you'd have 1 basis point. Correct, Ryan? Just ballpark there?
Yeah, that's correct. The other thing that I forgot to mention was with us, given the stage of Wolf3D and how much cash we thought they would need to have sufficient time to actually land some of these customers, we actually set a $500,000 escrow minimum. So if the company weren't able to raise more than $500,000, the money would have been returned to investors. So it's an additional investor protection to make sure that the company has enough cash to actually execute over the next 18 months or so.
Which is something they used to have in crowdfunding sites like Kickstarter. The big difference between Kickstarter and Indiegogo was, in Indiegogo, if you said, I need $100,000 to make my documentary, and you got 7,000, you could just take that money with no hope of ever finishing your documentary. Some people said, hey, that's unfair. But then the other person said, you know what, I'm going to take it from a documentary to a web short. And you know that going in, that we might do something smaller. But on Kickstarter, they said, hey, ixnay on the not reaching your goal. If you don't reach the goal, we're not going to release the money. It's held in escrow. So I like that. it's important that they have enough time, Ryan. Why is it so important that these companies have a decent amount of what we call runway?
Well, with all these startups, they're trying to find product market fit. They're trying to find willingness to pay. And it almost always takes longer and is harder than companies think. So you need to have some additional dry powder. For us, we typically like to see companies have 18 months of runway, just by a rule of thumb from seeing enough of these startups over time.
Yeah, that's exactly my rule of thumb is I ask people, figure out what your burn is. If your burn is $50,000 a month, then you're burning $600,000 a year, huh? 50 times 6, right? No, 50 times 12.
Yeah.
50 times 12 is 600,000.
Yeah.
And then here's how I do the math. You got another 6 months, which would be half of that 600,000, which would make it 300 on top of 600, 900,000. 50 times 18 is 900,000. That makes sense to me. Makes you feel pretty good that you have 18 months. You can make a mistake or two. You could lose a key hire, have to rehire somebody. You don't have unlimited resources, but you need to have enough resources that you can figure things out.
Exactly. And not too much, because you need to stay creative. And
right. If you have over 18 months, there is no fire behind you. So you need a little fire.
Yeah.
Bob Dylan always said, they said, hey, what was the behind this album or something? I remember Bob Dylan in an interview, and he said, I owe the label an album. I needed to get it to him. I did my best work when my back was against the wall.
Yeah.
You people are liars. I did the work because I had to. And he just basically was talking, and it was talking about Blood on the Tracks or something, like one of the 10 best albums of all time. And he's like, I owed the label a record.
Makes sense.
So I had to get it to them. There's no choice. Why'd you leave the song off? He's like, well, I owed them the thing. I wasn't ready. And so, I put it on the next album. A little bit of pressure is good. Okay, Ryan, let's talk a little bit about our partnership as we wrap up here. What would be successful for you if we got 5 or 10 startups to actually try this? That would be pretty successful. It's the first time anybody's ever done it, yeah? Where do you put the goalposts?
I think 5 to 10 companies would be great for both of us to run a pretty good experiment. I'd love to see more than that, obviously, but I think 5 to 10 would be enough to really have a good start. And, at the end of the day, for both of us, we both see the massive amount of potential. We both know how much fundraising sucks. So, live fundraising for us is working together to enable founders to reach a much bigger audience and make the fundraising process a lot quicker. So, if we're able to get 5 to 10 companies to do this and put them in front of an audience of 12,000 people at launch and 150,000 investors on our platform, next year between the two of us, let's get 50 companies or 70 companies.
10x it. Perfect. Yeah. Double the audience and 10x the number of startups. Yeah, I like it.
Yeah, exactly.
I like it. And so people know, my motivation on this is when I do a syndicate, obviously I get carry. So if I find the company, I vet them and I get my accredited friends to do it, I get 20% of whatever the gain is. So if $1 million goes in and 11 million comes out, there's 10 million in gain. I get 20% of that. I can make $2 million. That's a pretty good gig I got. I got a pretty great job if that happens. Now that doesn't happen all the time, but it does happen, and it's wonderful. And I feel very privileged to be in that position. Now with equity crowdfunding, I get 0. There's no carry for me. So just so people know, I'm doing this because the way I look at it is I'm going to be investing in these companies. I actually believe in my heart, more than anything, forget about supporting founders, which I do already. I believe this is supporting the middle class or even people who are poor or at the bottom of the middle class. I believe this is about economic mobility. I grew up, my family was in debt. Every argument my parents had was about money that I can remember. And it was a constant strain growing up, not knowing if we were going to hit our mortgage the next month and the credit card bills were getting higher. My parents were fighting over money all the time. It was brutally hard. And if only they could have had access to the ability to put a little bit of money into a high growth startup at the time, I would have told them Microsoft, Cisco, Novell. I was right in there. I knew about those companies because I was fixing computers for a living. I was a PC support specialist, microcomputer specialist. That was my first title, microcomputer. Because at the time, there were mainframes, minis, and we had microcomputers. So I was a microcomputer specialist. That's what they called PCs in the beginning. And as a microcomputer specialist, I knew to invest in some of these companies. Now, my hope is that people who are broke, poor, and looking to get in advance, I think it's wise to take some chances here and to make some bets. I don't think it's wise to bet on the Super Bowl or on blackjack. It might be okay to bet on poker if you got some skills and you know the table you're at. That's possible. But startups are, I believe, this incredible equalizer. Anybody who was on Twitter, Facebook, or LinkedIn, or used Snapchat, it didn't matter if you were poor or if you were rich, you knew the value of that software. If you used Slack in your organization and you were the receptionist, or you worked in the mailroom, or you were the lowest rung person at a company using Slack, you knew that Slack was a transformative company. If that equity was available, you would have easily put $500 into it and at a $10 or $15 minimum wage that the country is moving to in most cities. My gosh, it's 1 week's pay. I think you should all take 1 or 2 weeks' pay, or the equivalent of 4 months of cable bills. Americans pay $125 on average. Cancel your cable bill, stop watching TV, and invest in a couple of startups. That's my advice. If you want to be upwardly mobile, I think it's possible. God forbid you hit a home run. When do you think that's going to happen, Ryan? Is it possible that an Uber or a billion-dollar company will go through one of these platforms? Or is it an inevitability, or is it possible? What do you think is going to happen? When will that happen, do you think?
I think it's a matter of time. Yeah. And that's why I'm excited to be working with you on this, Jason, because you actually are a guy who found Uber and you found another unicorn, Thumbtack, right? Yep. So you've already shown that you have access to these companies, and now we're working together to provide access. That's what it's all about. Yeah. So it's a matter of time. Yeah,
it's only a matter of time. Somebody's going to figure it out.
Yeah, I think it's important for the market in general to start appreciating equity crowdfunding more, like high-level angels and VCs and stuff. When we started the process, we went and asked people, and the answers were not so sure.
All right, listen, let me make a quick disclaimer here. If you're conservative, you don't like to risk money, you don't like to place bets, and you're going to cry if you lose 10 out of 10 bets, don't do this. If you want to stay where you are and have safety and make 5% on bonds, by all means. If you want to put 5 or 10% of your net worth into this and diversify, fine. As far as I'm concerned, in America, you're allowed to do what you want with your money. I don't know if I'm a libertarian or not. I mean, it's kind of hard to define yourself in a world that changes so quickly, but I kind of feel like if it's your money, you should be able to do what you want with it. Whether you want to smoke cannabis, drink beer, go to the Super Bowl, go to Vegas, or buy books, or invest in startups. Do what you want with your money. You're an American. I hate to make this about America. I know you're from Estonia, but we are here in America. As an American, you should be able to this is America. You should be able to do what you want with your money. I believe that. And I think that we're on the cusp of consumers and Americans and individuals being able to have the freedom to do what they want and potentially have great wealth creation. Nothing is guaranteed in this life. Could be a meteor, could hit the whole planet. We could all be foobarred. Could be over any minute. But why not take some risk? People don't take enough risk in life. That is one of the things I have learned on my 46 years on the planet. Take a little risk. Take a little risk. I'm not saying take stupid risks. I'm not saying go paragliding. I'm not saying go scuba 200 feet underwater, but going scuba 20 feet or 30 feet underwater, I think you can make it to the surface. There's a difference. You understand what I'm saying?
Yeah.
You ever go scuba diving?
No, but I just went snowboarding 2 days ago.
You went snowboarding?
Still snowmobiling.
Snowmobiling? Yeah, that's not as dangerous, I don't think, unless you were drinking while you're doing it. Listen, if you're scuba diving, there's a big difference between being an idiot like I was when I was a kid and going 130 feet down in Mexico with a resort diver and no certification when it's your fourth dive. Can't believe I did something so stupid.
I did the same thing.
You did the same thing, Ryan?
I did this. My first real dive was in the Philippines.
Yeah.
And I did a wreck dive that was about 160 feet when I was supposed to go no deeper than 15 meters or about 45 feet with open water. So I was on 3 oxygen tanks, and it's been easier ever since then.
Yeah, I mean, you just have to have some intelligence here, and know your lane and know exactly what you're capable of. I'm not saying be Ryan and go 160 feet underground, 160 feet down. That's dumb, Ryan. It was dumb for me to go 130 in the Plancar Reef. This is stupid behavior.
It was.
Now, if I ever go, listen, trust me, there's nothing at 160 feet that's as delightful as 30 or 40 feet. all the good stuff's at 30, 40 feet where the sun reaches. When you get down to 160, it's cold and not fun.
You know what is like? You know what kind of is like scuba diving at 160 feet when you just got certified? Going on certain platforms that don't do any vetting or get you into common equity or a crazy valuation. So just be careful.
Yes.
If you're investing in startups, make sure you're smart and you do your homework. Every platform is different.
I think that this is a very good point.
Yeah, bad platforms could ruin the dream.
There are platforms, they shall remain nameless,
Right.
where I don't want to say anything bad about people. I'm trying not to, at least. I mean, I was a little bit sharper elbowed in my younger years when I was diving 130 feet with no license in Mexico. But I will tell you that on some other platforms, I saw the companies that all the other investors passed on. Syndicates, angels, SeedInvest, proper angels directly investing, VCs. And I saw a company that was raising for a car company that's going to compete with Tesla.
Yeah.
They were raising at like $100 million valuation in common equity or something crazy like this. And I said, this is the stupidest thing I've ever seen in my life.
Yeah.
This is a company that has no chance. You're going to put this company against Elon Musk and Tesla with escape velocity? It's a decade. You're a decade too late. It would be like you're doing VR 10 years from now, and you have the same idea for Wolf3D in 2027. It's not the same idea in 2027 that it was in 2007. And you have to be careful as an investor. One way to do that is to look at multiple platforms and start meeting with people and learning. That's why starting slow and diversifying, Ryan, are key, right?
Absolutely. And that's my biggest concern about this whole space. It's a privilege. And it is an opportunity for entrepreneurs and investors that we've never seen before. But I guarantee you, if there are a lot of people out there that screw it up for the rest of us, it's going to be a problem. And it's all about education.
Yeah.
Right? People that are investing for the first time need to understand why common equity is not a good idea. They need to
Why is it not a good idea? Why?
It's not a good idea because let's say I give you $1 million for your company at a $2 million post money. So I give you $1 million, Jason, and I get 50% of the company.
Okay.
The next day you sell your company for the $1 million worth of cash you have in the bank, and you run away with $500,000 of my money.
Right.
Legally.
Yeah.
Right. So preferred stock, I get my $1 million out first before you get a dime as the entrepreneur. And it's just a simple protection. If you're not raising money from friends and family that you know extremely well, you need some basic investor protections out there, and that's not happening on other platforms, which is a problem.
Preferred share makes total sense.
Yeah.
Most platforms only do like legal due diligence. They have no business, nothing. SeedInvest went through our whole business like a normal VC or angel would do.
Yeah.
And all platforms should do that.
I think they're signaling. I'll give one piece of advice. If you don't see other people on the cap table who've had other previous success as investors, that's a tell. So if you don't have a Chris Sacca or a Cyan Bannister or Jason Calacanis, whoever involved, and that's why I put that, hey, listen, I'll put $5,000 into any company that does this as a little test, what I call a feeler bet in poker, like a little feeler bet, like, hey, there's $1,000 in the pot and I'll put $800 out. Under the gun. Let me see if anybody wants it. Maybe I'll get that $1,000. Hey, if it works, great. If it doesn't, no problem. A little feeler bet sometimes is a good idea. This is my feeler bet. But that's why I said pending due diligence. If I see somebody has an absurd valuation and it's not enough runway, whatever it is, I would pump the brakes immediately and say, hey, whoa. And Ryan would too. So you have like a 2-level filter right now, which is good, I think. You want to give the opportunity, Ryan, right? But you don't want to give it to people who are irresponsible or who are not realistic.
Yeah, and the other thing that's important is that maybe 10 years down the line, the crowd, if you will be able to negotiate all their valuations themselves, and there'll be a perfect market. But that doesn't exist today. So there are other platforms that whatever valuation the entrepreneur comes up with, that's what it is, and there's no that's it. Whatever the entrepreneur sets, that's what you go with. And investors that haven't invested before you might be sophisticated, but if you haven't looked at a lot of VC deals before, you don't know what's appropriate. So it's really important to have somebody in the middle right now, a platform that is setting an appropriate valuation for everybody.
Yep.
And keeping both balancing the investors and the entrepreneurs for this to work.
All right, listen, there's over 150,000 investors who've registered for SeedInvest. 25,000 of them are accredited, and $60 million has been invested online at SeedInvest. 115 companies have been funded, and they have a 1% historical acceptance rate. So they're running a tight ship over there. 500 plus startups applied in the last month, and they expect to fund 100 companies in 2017 and hit 10 million in monthly investment volume. You're setting, I think, those aren't too aggressive goals, but they're just right. Sounds just right to me.
Yeah.
And they're doing these side-by-side rounds, which is accredited, non-accredited. A company can raise $1 million from non-accredited investors through Reg CF. Potentially a couple million more from the accredited investors. So, it's called Reg CF. What does Reg CF stand for?
Reg CF, regulation CF, regulation crowdfunding.
Got it. And that's an SEC label, correct?
Yeah, that's right. It's the SEC term for regulation crowdfunding. So you basically can raise up to $1 million by law through regulation crowdfunding from smaller investors, non-accredited investors, and then with the side-by-side that we're now doing with companies, you can raise up to a couple $1 million more from accredited investors at the same time. So we see a lot of companies looking to do that now.
Fantastic. All right, listen, this has been amazing. Timmu, I wish you the best of luck with your company. I'll see you at the Launch Festival. Congratulations.
Yes. Thank you.
And everybody who's coming can see that. If you want to come to the Launch Festival, go to launchfestival.com/tickets. If you're a founder of a company, depending on when you hear this, you can come as my guest. They give you a wristband. You don't get to come to all the dinners and lunches, but you get to come to the event for free. That's our way of being super inclusive. If you want to, you can buy a ticket for $500 to the Angel Summit the day before, or a VIP ticket for like $1,500. All of that goes to put the event on. We don't make a profit from the event. We do the event to support founders and inspire people to innovate. That's our mission here at Launch, to support founders and inspire innovation. That's what we do. Launchfestival.com. It's happening. The main event is the 6th and the 7th, Thursday, Friday. And on the 5th, we're having the Angel Summit. That's the little elite smaller event the day before, where 40 angel investors and early stage VCs are going to speak about their portfolio, what they've invested in, what they're going to invest in, or what they're looking for, and maybe a topic that they care very deeply about, or some observation they have of note. So that's really fun. The Angel Summit is the day before on the 5th. There'll be 120 companies across 10 different summits, plus another couple of dozen companies presenting on 3 different stages. It's an amazingly large event, and there's a demo pit with all the companies in it. You can go talk to the founders. And that's really what this syndicate, I call it the syndicate, is what I'm going to call the TV show that this is based on. We're going to make it into a little bit of a TV show. It might be a web show, it might be a TV show, it might be on a streaming service, who knows. But we're going to try to develop this into a show, and it's going to be called The Syndicate. And the Syndicate show will be me and a bunch of my friends investing on the SeedInvest platform in companies. So come on and see the show, everybody. You're going to love the show. Ryan, I'll see you in a little bit. Thanks for the support.
Thanks.
And this is going to be fun, I think. I'm really
Always
excited.
Always a pleasure. Look forward to making history with you in April.
Yes, I think it's going to be a historic event. It's funny, now that we made this announcement, Ryan, I got everybody in the world now wants to be involved. And
awesome.
Everybody's like, I had that same idea. And I'm like, yes, I know. The idea is not that revolutionary. Yes, an event where you can invest in the companies on stage. Yeah, of course, everybody had the idea. We're going to be the first to do it.
I think it was Thomas Edison that said, ideas are worthless, execution is everything. So
Absolutely.
We're the ones actually doing it. 4 years ago, I saw this coming, and I did a simulation at the Launch Festival where we had you invest launch dollars. And it was just a simulation to see, hey, if you could, would you invest? And we had a leaderboard, and people gamed it a little bit, but it gave us a little bit of faith that, hey, this would be interesting. And I am going to send an email to everybody coming and to my other list of 80,000 people. And across my 500,000 social media followers on the show, I'm going to talk about the companies that are going to do this crowdfunding. So you're going to get a lot of exposure, and you may receive continued investment and have great investors in your company. So I think it's a worthy thing to do. I love the innovation. I love the fact that, Ryan, you're so supportive of it. Thank you so much for the support and for really being diligent and doing the work. That's what I'm looking for. Everybody wants to have lunch with me to do a partnership. You know what I tell people? Do the work. I want people who are willing to do the work. I got so many people, Timmu. You know what this is like, well, you will soon learn. Everybody wants to eat the apple pie.
Yeah.
Not everybody wants to pick the apples. You understand this metaphor, Timmu? Do they have this?
I do.
Do you have this metaphor in Estonia?
No.
Do you have another one? Everybody wants to milk the cow. Nobody wants to feed the cow. I don't know.
I don't
Tell
have
me.
one in mind. No.
There's not one from Estonia.
I don't have one.
Everybody
in mind.
wants
probably.
to eat the pie.
Yeah.
You understand the
Nobody
apple pie?
wants to work, of course.
Nobody wants to pick the apples.
Yes.
Picking the apples is the work.
Yeah. No, I get it, of course.
Eating the pie, you understand? Timmu, let me explain it one more time.
Okay. Love it.
Everybody likes to eat pie. It doesn't take any effort.
Yeah.
You understand what I'm saying?
Sure.
Picking apples is work.
Yes.
Okay, now you
It's
got
hard.
it. You
No,
got it.
I
now.
got it before.
You got it before. Okay, I'm buzzing your job. I like this kid. How old are you? Were you 30?
23.
What?
23.
23. My God. When I was your age,
That's why I'm fresh, not because I slept.
23. When I was your age, I was publishing my own goddamn magazine. So don't give me any shit. Oh, sorry. Don't give me any sugar, millennials. I worked my whole damn life. All right? I was an entrepreneur by the time I was 23, 24.
Awesome.
Started my own magazine. There was no crowdfunding back then. You know who my first two investors were?
No.
American Express and Visa.
That's pretty good.
Those are my first two investors.
That's pretty
Visa was a very tolerant investor. American Express, not very tolerant.
good. Okay, I'll keep away from them.
I took the money from American Express, Ryan. You know what they did? They emailed me the next month, said they needed it back.
Really?
Well, when I say American Express and Visa invested in my company, I mean I put the expenses on my credit cards. So like they weren't strategic investors. They didn't know they were investing.
That's
I just
good.
spent money. No, I literally put the printing of the first magazine on my credit cards.
Yeah.
And then I went out and sold the magazines and sold the ads. And I had to go to Jeff Dodges from Razorfish and Fred Wilson and Jerry Colonna from Flatiron Partners who bought ads, and I said, can you give me the money now? And they're like, yeah, well, the invoice is in the system. I was like, no, I really need it now because I have to pay my credit card. And they're like, who are you? And I was just like, I'm just a hustler from Brooklyn. I'm just trying to make it. I'm trying to grind.
Entrepreneur.
That's it. All right, listen. Timmu, you got a lot of work to do.
Yes.
Now you got the pressure's on.
Yes.
Everybody thinks raising money is the hard part. You know what the hard part is?
I'm
Getting
going to
a
find
return.
out. Yeah.
Getting a return. Isn't that right, Ryan?
That's right. Absolutely.
As hard as it is to raise money, it's harder to get a return for your investors, and that's the goal.
Yes.
You got to go out there and get a return for your investors. Make Ryan look smart.
Picking the apples.
Pick the apples. Get to work. All right. Thank you so much, producer Jackie, Julia, Master Jake, Luke Lightning, Ashley, Austin Lon. I could go on and on. There's a lot of good people who work with me. I'm a lucky bastard. All right. We'll see you all next time on This Week in Startups. Bye-bye.